Good morning, ladies and gentlemen. My name is Ngatia Kirongi, and I am the head of the KEPFIC Secretariat. KEPFIC is short for the Kenya Pension Fund Investment Consortium. And I'd like to thank you all for joining us here today, this morning, where we'll be talking about all things affordable housing, which is a big priority in our country right now, and as such is also a big opportunity for pension funds and institutional investors. Before I start, let me give a brief background on KEPFIC. So KEPFIC is a consortium of local pension schemes, both public and private pension schemes, large and small, that have come together to jointly assess and invest into alternative assets or alternative investment opportunities, including infrastructure as well as housing opportunities. We have worked together with the Kenya Property Developers Association as our partner to put together this event today. And we are very thankful for the support they have given us and have given the large institutional investment community as a whole to understand affordable housing so we can best be placed to take advantage of these opportunities. And today we will take you through the status of affordable housing. We will discuss opportunities and hear the views of private sector developers, fund managers, as well as pension schemes. And with that, I would like to hand over the discussion to Mr. Zoravar Singh, who is the chair of the Affordable Housing Task Force within KPDA, to lead us forward on this session. Zoravar, over to you.
Wonderful. Thank you so much, Gatia, and the entire KEPFIC team for making today possible. Thank you, attendees. We're excited to dive into this important topic of affordable housing, and really excited that we have got an excellent lineup panel after the presentation, where we're going to engage in discussion, hearing perspectives from fund managers, from pension, from developers, trying to understand how can we accelerate investment into the sector and see more housing and more uptake of housing. So we're really excited about today's conversation, and we thank everyone for joining us. I'm going to give a brief presentation on elements of the affordable housing sector as a background, and that will help to set the context for today's discussion and panel discussion. So I'm going to share my screen here. Great. Wonderful. So today, okay. Great. So today, I'm assuming everyone can see this. Maybe someone can just say a small message. Yep, can see it okay. Yeah, okay, wonderful. So today's presentation is on affordable housing investment. And the focus really is understanding opportunities in the investment landscape and how we can think about investments from the pension perspective, and also thinking a little bit about risk management strategies. So this presentation has a lot of information on it, and it will be circulated around to the attendees and KEPFIC members. So, you can feel free to take notes, but also you will also receive the presentation. As Gati had mentioned, this is a collaboration. This webinar is a collaboration between the KEPFIC and the Kenya Property Developers Association Affordable Housing Task Force. We'll get a little bit into what the task force does in some of the slides. And as Gati mentioned, I chair the task force, and we are a multi-stakeholder group that is focused on accelerating the supply, the demand, and policy changes within the affordable housing sector. I am the MD for iJenga, which is a real estate development, management, and advisory firm here in Kenya. So with that, I'll jump into the presentation. The first part we'll talk about is trends in the affordable housing sector. Then we'll get into investments considerations for affordable housing. And then we'll briefly touch upon risk management, real estate risk, investment risk management. So jumping in, we start off with some headline figures. And I think a lot of us have heard about the gap in housing. And, we talk about 2 million units as a housing deficit. We talk about an annual or housing need, and we talk about a 50,000 unit supply on an annual basis. But there's a demand of 200,000 units on an annual basis. And so that gives us an annual shortfall of 150,000 units approximately. And that's compounded with our 2 million unit shortfall. And what does that really mean? Affordable housing in an urban context, which is largely what we'll focus on today, really is everything from what we see in informal settlements, the lack of quality housing there, but also in buildings as well that are perhaps not built to code and are perhaps not at the quality that we might expect them to be. And also, it is also about pricing of affordable housing, where a household may be spending more than the normal threshold of a third of their gross household income on housing. So families and households in Nairobi and other key cities spend upwards of 30, 40, 50% of their income on housing, which makes day-to-day living very difficult and expensive. And so the challenge really is how do we provide housing that is affordable and accessible to urban dwellers, and that's a coming together of the supply and the demand, which we'll talk about today. We've seen a lot of changes in affordable housing over the last 4 or 5 years, particularly since the housing agenda has become a part of the Big Four. And Gatia will touch a little bit upon what the government is doing around the public, the government programs on affordable housing. And I'll touch a bit upon what we're doing at the KPDA as a task force on affordable housing. As you can see, that there is a number of different ways to look at the sector, of course, from a developer's perspective, from government's perspective, from buyers or renters, the end user. And normally we classify some of this work into supply, as in supply of housing, so the developers, the demand for housing, which is where the buyers, the renters, and the mortgages and the housing finance comes in, and in government, creating the right policies, the incentives, the urban planning. Prior to the Big Four agenda, we saw that developers were largely focused upon larger units, higher end neighborhoods, higher end pricing, because developers saw the opportunity there. And at the same time, there was limited access to mortgages. There was a smaller push or smaller focus on mortgages. And the government didn't have a specific affordable housing agenda. Enter the Big Four around 2017 is when we started to see a big emphasis upon looking at affordable housing. This is also around the time the task force was formed. Actually, the task force was formed even before that. And it was really driven by the need for housing. And the need for housing is very apparent when you are driving around Nairobi in key neighborhoods. So that's where that spawned. And at the same time, as we saw the focus for the Big Four agenda, we started to also see the banks and the SACCOs starting to design products and getting into housing finance. We saw the KMRC come about. So we've seen a number of changes in this sort of segment here. Going forward, we're expected to see continued changes. And the expectation is as developers professionalize and institutionalize, and as projects make more economic sense, as we leverage the government's incentives on affordable housing, we will start to see larger development programs, so 1,000-unit plus projects. At the same time, as Gatia will touch upon in a few slides, we are seeing the government also focused on affordable housing supply. and focused on large-scale programs and projects as well. And from a buyers and renters perspective, we are seeing continued innovation. For example, we are seeing new credit scoring technologies. We are seeing now SACCOs having the capacity to lend mortgages in a mortgage fashion versus in an asset finance fashion, meaning smaller down payments, more mortgage-like longer duration products. We are seeing banks innovate also on their mortgage products. We are seeing more private equity funds enter the market and focus on rental and tenant purchase schemes. So we are seeing a lot of changing dynamics. From a private sector standpoint, the KPDA's Affordable Housing Task Force has three main program areas. So the first is on stimulating supply, where we have a capacity building program that focuses on building developers and the sector's capacity to design, construct, and manage affordable housing. Secondly, on enabling demand, we have two initiatives. One is working on housing finance products, and we are specifically engaging now with the SACCO community, and this project is in design. So it's still early stages, but that is an area that we're engaging on housing finance. Also, we are focused on the rental supply, because the housing stock for any country requires a quality rental supply as well. And so this is where our engagement with KEPFIC and the pension community comes in, because we need to see long duration capital in the sector to be able to own and manage this housing stock for rent. It's a norm that we see institutional investors in the rental sector. So this is where we're engaging, and this is part of the conversation today. And lastly, on policies, progressive policies, we've got two initiatives. One is on what we're calling the Housing Policy Task Force. This is where we engage with national government on policies and incentives. So the task force working with the ministry worked on the KRA, the VAT incentive, and that was passed. And now we were engaging with the ministry on the implementation of that incentive. And also we are regularly reviewing policies and bills and acts that are in changes. And then lastly, on the community-friendly urban planning, that's an initiative where it's another early stage initiative where we're working with counties, engaging with counties on urban planning, local planning. How do we make community-friendly neighborhoods? How do we design state-of-the-art infrastructure? How do we ensure that the planning departments have the right capacities and skills? So this is our initiatives at the Affordable Housing Task Force. We've got about almost 30 members. You can see from various organizations working on various initiatives. And you can see we have representation from developers. We also have representation from different associations. For example, KEPSA is strongly represented, the Architects Association, the REITs Association, Kenya Green Building Society. We have banks like NCBA and KCB. We have DFIs like IFC, and we have building technologies like Kung Kong and 14 Trees. So it's a hybrid of organizations that have come together to really advance the housing agenda. We are always open to accepting new members on this, so you're welcome to reach out if there's a fit. We can certainly discuss. I'm going to hand the next couple of slides over to Gatia, who will speak about the government's affordable housing agenda. Gatia, would you be able to speak on these, please? And just let me know when you want me to switch slides, please.
Absolutely. Thank you, Zorova, for that introduction. I think we don't need to hear too much about the Big Four agenda. I think we are all familiar with what has been essentially been the government's priorities over the last 5 years. So that's the development of 500,000 affordable homes, the increase of manufacturing GDP to 15%, 100% food security, and universal health coverage. And we're here to talk about affordable housing. So we could move to the next slide. So Zorova mentioned that there is a very large gap between the supply and demand for affordable housing. As you can see, that current housing deficit is estimated to be about 2 million homes and growing at a rate of about 250,000 annually. What you can see from the bar chart on the far left is that there is a lot more demand for low-end or affordable housing than there is supply. You're looking at demand of about 170,000 per annum, yet supply is a paltry 1,000. If you're right now looking at an investment opportunity, that should tell you something. It should tell you that there's a significant room for or scope for growth in that sector. And when you compare that to, say, high end, where you can see that despite the supply not matching demand, it's still a lot closer than what you can see with affordable housing. Next slide. So government has tailored or has targeted the program, the affordable housing program, really to 3 income segments. If I can start from the very bottom, that's the social segment, which is Kenyans that earn between 0 to 20,000 shillings. And that's, I think you'd typically understand that as slum upgrading. The next category being low cost. And these are Kenyans who earn anything between 20 and 50,000. And finally, the mortgage gap, which is between 50 and 150,000. That mortgage gap really are Kenyans who have, they have the ability to pay for a mortgage, but really are unable to access those mortgages in the first place. And that's where you have initiatives like the Kenya Mortgage Refinance Company that have come in to try and provide greater end user finance away from just the middle and high income, which you can see there at 150,000 plus, and start to go lower and lower down the economic or down the income segments. Next slide. Zorova, next slide, please. So when you think about affordable housing, there is a big concern that what we're talking about is concrete jungles, and no, that's not the case. Affordable housing, the affordable housing program is not just focused on price, whereas that is really a critical element. It's not to build as cheap as possible anything. And so these are the key design principles that are shared across the portfolio of projects that have been approved and that are currently under construction. So having significant or sufficient open space, having access and movement, things like footpaths and bicycle lanes and the likes, safety and security. We're talking about high density residential projects, so safety and security are key. Creating communities is important, using innovative building technologies, which will help, number one, with a faster turnaround time in terms of construction. And also with that comes some cost savings as a result. And paying close attention to environmental sustainability and use of smart technologies. Next slide. So that number that government has often quoted and has often said that we are looking to do 500,000 units has raised a lot of skepticism in the past or even currently. However, I'm here to show you that this is the current pipeline of projects that are either completed, ongoing, or under evaluation, or basically planned from both the public and the private sector. When I say public, I mean both national government as well as organizations like National Housing Corporation, and the private sector. And these are names I'm sure a lot of us are familiar with. These are private sector developers that are profit motivated, like we all are here. And you can see that if you put together the entire pipeline, we're looking at about 564,000 units. And that, like I mentioned, these are projects that are under various stages of development or of planning. But this is to show you that there are projects out there. The opportunities are real, and the national government, together with the partners like KPDA, are looking to ensure that there is an enabling environment so that we can have more private projects in this pipeline, and so that we can have greater end user finance, so that we have buyers for these 564,000 units. The good thing is that, having looked at the statistics before, we know that there is a lot more demand than can be supplied at this point, which is a great position to be in as investors in affordable housing. Next slide, please. So one thing that has been clear to government is the need for demand-driven supply. So no longer, I mean, it's completely understandable why a developer or an investor would be cautious about building a large-scale development or a large-scale project. The question that would be asked often is, I might build, but who will buy? And that question is not just asked by the sponsors or the project developers, but it's often asked by the financiers, by the banks. And the banks will always ask you for a feasibility study, a market study. They will ask you for pre-sales and to first show to show that you actually do have demand for your product. Well, in the case of affordable housing, government has stepped in to actually aggregate this demand through the Boma Yangu portal. The Boma Yangu portal or Boma Yangu platform is the platform through which Kenyans are registering for the affordable housing program. It's bomayangu.go.ke. And as you can see, there are about 320,000 Kenyans that have registered for this program. You can see their total registered on the far right, second row. Of those 320,000 Kenyans, over 10%, so these statistics have been updated recently, there are about 32,000 Kenyans that are actively contributing, and they have contributed over 1.3 billion shillings simply into saving into their Boma Yangu accounts to save up for a house. And what this does is that now we are able to put projects onto the portal. As you can see, there are 36 projects that are on the portal today. And for developers out there, they have essentially 320,000 Kenyans that will see their projects at one time. I would challenge anyone to tell me which agents or agency could do that. Yeah, or you'd have to spend a lot in terms of marketing to get that same kind of reach. But it's not just eyeballs that are important in this case. It's also having the cash behind that indication of interest. So we have, like I mentioned, that 1.3 billion or so that has been saved onto the platform. And once a developer launches their project onto the portal, these 320 Kenyans can actually select specific units on each of these projects, and then can allocate or can transfer their savings into those projects directly, or at least you can hive them off into those projects. And what that does is that the developer can now go to their bank or to their investors and say, we have put our project on this portal. We want to build 1,000 units, for example. We have got interest from 5,000 Kenyans. And of those 5,000 Kenyans, maybe 3,000 have set aside the 10% deposit required. So suddenly you are able to de-risk a project significantly simply through aggregation of demand through the use of technology, as has been done. Maybe another thing before we move on is that financial institutions like the banks are also a very integral part of this Boma Yangu platform. And through the banks or through the platform, the same Kenyans who are registered can now apply for mortgages directly. So you don't need to walk into a bank branch. As you're registering on the platform, you put in all your details, and then you can apply for a loan directly. And the bank is able to see who you are, but is also able to see your savings history. And from that, give a sense of the kind of loan or mortgage you can pre-qualify for. So even before choosing a home or before you find a house that you're interested in, you can have all the banks reach out to you and say, based on your profile and your savings contribution so far, we are willing to extend a mortgage of 2 million shillings to you. Now, what the buyer can, what the contributor, what the registrant or the member of the public can do then is now they have essentially 2 billion shillings in their pocket that they can now go onto the platform and look through, for example, these 36 projects and find a unit or a project that is suitable for them. Next slide. So like Zorova said, we often think about affordable housing from the supply side and the demand side, with the supply side being the developers. Now, the most important thing we're trying to do, or the government is trying to do, is lower the cost of development. And government is doing that in various ways. I mean, the the most obvious way is the provision of free land where possible. Yeah, but we know that government doesn't have unlimited land, especially not in areas that would probably be in high demand from the public. So the most attractive pieces of land are actually owned by the private sector. But what the government can do, and what it does have power to do, is to incentivize developers through taxation elements. So this is a summary of the tax incentives that are available for developers right now. You can see the first two are probably the ones that really move the needle, and that's the exemption of VAT from affordable housing. So VAT on construction inputs of 16% is completely waived for affordable housing projects, and that would result in up to a 9 to 10% reduction in construction costs, which is very significant. You can imagine what that can do for prices. Then we also have the corporate tax incentive, where if you're a developer or an investor who builds over 100 units in a year, your corporate tax rate moves from the current close to 30% down to 15%. And that can also have an effect on pricing ultimately, because you can have the same target margin or same target net profit that you'd like, but this time with lower turnover because you have lowered your pricing, but all as a result of being taxed lower. Then we have the other three incentives. There are tax incentives, import declaration fee and railway development levy, which are important when you are importing goods, and thin capitalization. Next slide. But there are also tax benefits for homeowners as well. Now, this is now where we talk about the demand side. So the first is the stamp duty waiver. So if you're a first-time homeowner under the Affordable Housing Program, you won't pay the 4% stamp duty that you'd otherwise pay. So that's a significant incentive for buyers to participate under the AHP. And then we have a number of reliefs, from the mortgage relief and going all the way to the homeowners savings plan, as well as affordable housing relief. Now, these reliefs are really there to encourage savers to put money aside into affordable housing. And by saving into the Boma Yangu platform, or saving into an approved bank that has a mortgage or home ownership product, essentially what happens is that you can actually get a direct deduction on your taxes due. So in the case of the affordable housing relief, that's 15% of all your contributions. So if you have contributed, say, 100,000, 15% of that is 15,000 shillings. At the time when you're paying your taxes, it would automatically be netted out of what you actually owe the Kenya Revenue Authority. So this is government essentially saying we want to do as much as possible to make home ownership as accessible as possible to Kenyans in our country. Next slide. So when speaking to a diverse group as we have here, it's important to talk about where do the opportunities lie. Well, first, if you think about the investors in this room, these projects require financing, they require investment, and once they are well structured, and once the returns are meet investment thresholds, there is really a massive opportunity for us to take advantage of here. In terms of the expertise and services, here's now when we look at the service providers, whether it's legal, financial, technical. When I say technical, I mean the built environment specialists. But I'd also add there, and probably should go without saying, but I'll also add there the contractors who would be needed to build these large scale projects. And finally, looking at the value chain. So these are the supplier inputs. So these are the doors, the windows, the local content that has been earmarked for under the Affordable Housing Program. I believe the Juakali associations have been engaged on a number of projects, and they have been some of the inputs have been set aside for them. I think in the Park Road project, for example, all the doors came from were locally manufactured and were produced by a consortium of Juakali organizations to fulfill that local supply requirement. Next slide. So with that, I'll hand over back to you, Zorova. Thank you.
Wonderful. Thank you so much, Gatia. That was very helpful in understanding the government's affordable housing program and the great momentum the Ministry of Housing has made over the last 4 years. And we're excited to continue to work together on some of these incentives and the programs. So I'm going to move to the next part of the presentation, and I will try to move a little bit quickly because I know we've got a really good panel today, and I just want to make sure we're giving the panel enough time to share their insights. So next is focusing on investments in affordable housing, and so when we and our this presentation is a bit geared to the pension community, though it is relevant still for other institutional investors. And so when we think about real estate, just generally from an asset allocation perspective, we see it's kind of falls somewhere in the middle in terms of the risk return. The great benefit, so it's not so perhaps as secure as things like cash or bonds, but the great benefit with real estate investment is that you have an underlying asset. And so that underlying asset, normally prices don't devalue so quickly, and so the asset itself retains its value. The benefit that pensions normally find with real estate is that it matches their duration of investments and payouts, and they can be considered sort of medium to long duration investments. And they get a good yield, which helps combat inflation, but they also get capital appreciation over time, which comes with the responsibility, of course, of managing your real estate in a high quality way, so it doesn't reduce in quality over time. But there are many great advantages for investing in real estate. Now, in the pension sector, and I believe even this might be slightly outdated now, because I think that there's a new allocation specifically for affordable housing, and perhaps one of our panelists, Joseph Rono, can touch upon that during the panel conversation. But there are different mechanisms by which pensions can invest in real estate. And I think all the pensions are familiar with this. Direct investment in property, which is actually how most pensions have invested in the sector. And I think the general allocation across the sector is something like 26 or 27% in the property segment. So this is the way that pensions have historically been investing in the sector. And we are finding that some of the pensions are hitting the upper bound of the 30%. And so, it's also time to look at other instruments, for example, like real estate investment trusts, which has a capacity for 30%. And one of our speakers today, Ruth Okolf, is from Fahari REIT, and so she'll touch upon that. And also private equity and venture capital is also considered as alternative investments. And private equity is another great mechanism that can be used in the affordable housing sector. There is a new affordable housing fund called IHS, International Housing Solutions, out of South Africa, that has been established here in Kenya. They help invest, they support investment in the development process. So that's normally where we find developers are lacking, perhaps, developers' equity. So different private equity funds can come in and invest in those projects at an early stage to benefit from the returns on those projects. So there's different mechanisms that pensions can invest. And, we've talked about the supply side and the demand side. The supply side largely is in around the bringing housing to the market. The demand side is around the mortgage refinance that we have. But actually, another way we can say kind of the coming together of the two are things like rental properties, which is fulfilling demand, but also supply because you can invest in the actual development of a rental building and then hold it as an asset, which is essentially operating on the demand side as well. So there are some different products, and these are sort of the descriptions of different products and some of the benefits and limitations of the different types of ways to invest in the real estate sector and the affordable housing sector by pensions. I won't go through all of this in detail because you'll receive these slides, but the one that we're really heavily focused upon is on the REITs investments, greater increase in REITs investments by the pension community. We think that there's also an opportunity for pensions to be investing in more real estate private equity funds. And of course, investing alongside developers in their projects. And so that could be, an example could be where a developer comes to you, has a project, the pension invests in the project, and then either if it's a units for sale, will benefit from the returns of the project, or if it's for rent, as an investment into the equity of the project, will slowly then acquire or do a forward purchase agreement for the building, so the pension can eventually own the rental building. So there's different mechanisms. Also, here's investing in a developer as well. You can directly invest in a developer. We see this with some of the larger pensions in North America, where they have invested and purchased and acquired real estate companies to operate their real estate arm through those companies, whether it be property management, whether it be development management. They are those wholly owned subsidiaries of those pensions to execute upon real estate projects. Other ways that are other opportunities perhaps are infrastructure debt and mortgage-backed securities or mortgage refinance, like we're seeing with KMRC. So these are different ways to invest into the housing and affordable housing sector. Now, specifically within affordable housing, you've heard both Gatia and myself talk about the supply shortfall, and there's a lot of reasons, there's a lot of challenges that the sector is facing to sort of explain why we are seeing those shortfalls in housing. For example, the urban planning, when we are having land prices that are increasing, we need to see a corresponding increase in density in terms of like number of floors or heights of the building, so more built up space, but that requires infrastructure and good urban planning. And right now, we may not have the infrastructure we need in some of the urban centers. And so we are finding, more and more blackouts happening. We're finding shortages in buildings with water. You might find in some locations, you don't have sewage, so you have to either invest in a septic or biodigester, which increases the price of the project. That also ties to cost of development. We are considered to have a high cost of development here. And things like infrastructure that needs to be built that was normally a part of government investment sometimes has to be absorbed by the developers and the projects. Other things like, because we don't have the right economies of scale yet in the sector, we find some of our inputs are expensive. Steel is expensive, sand is increasing in price. Construction finance, we all know where the bank lending rates are, but also the availability or access of finance is a challenge for many people. Similar for mortgages, we found that accessing mortgages has historically been a challenge. We're seeing more and more mortgage innovation. One of our task force members at NCBA is doing great work in mortgage innovation, and they've got a lot of products coming. And in fact, the KPDA is going to be doing a webinar on or a session on mortgages with the NCBA. And also KMRC has done a lot of work on the mortgage innovation process for SOCOs. And so we are seeing more and more SOCOs now being able to extend mortgages. I see someone has their hand up. Maybe what you can do is just put questions in the chat box for now, and then when we open up for the panel, we'll definitely make sure we touch upon some of those questions. And then inefficient processes, so this is whether it be the titling processes around sectional properties, whether it be about extortion perhaps that is faced when going to get your development permissions from the government. There are a number of challenges that are roadblocks for developers that increase the cost of development as well. Moving on, in terms of the housing stock quality, this is exactly where we see the challenges with housing. For example, informal settlements or slums are really not habitable living conditions, but they are habited, and these are places where we need to see greater investment. You see a hybrid of buildings that have come up. You can see that there are issues in terms of the construction quality. We have issues around buildings that are falling. They're not built to code. They don't have elevators where they need to. They don't have sufficient windows, hallway spaces, fire accesses. So those are a challenge. And then sometimes there is some housing that is maybe far outside the city and requires 2 hours, 3 hours, 1.5 hours for commute times. So these are all challenges when it comes to housing. And this is where we think that we need to see an improvement in housing. And this is perhaps why the government has come up with the affordable housing agenda. But also there is a huge employment benefit that comes with housing. So not only are we building dignified homes for people, we are also creating jobs. So the World Bank estimates that for every 1 unit that is developed, 5 jobs are created and 8 indirect jobs are created. And so there's a huge employment potential if we can really accelerate our housing process. So you saw Gatia touched upon this a little bit with his in the slides showing the different price points where we're seeing structural challenges around housing access. This is something similar where we are talking about, who is the most affected by the housing failure? What are the challenges that social housing or low-income housing households are facing? So social housing normally is essentially the informal settlement of the slums. We know that one very clearly. That one is very, very clear to us what the challenge is. On the low income side, this is a lot of this has to do with those issues about pricing of housing, quality of housing, location of housing. So you might find something that you can afford the rent for, but that might be 2 hours out of the city. Or you can live in a home in a city, but it's very small, it's not built to code, it's low quality. So these are the challenges. And some of the investment opportunities are listed here in terms of how, as a pension, you might engage in these investments. Now, the Affordable Housing Task Force had worked previously upon investment cases. Now, investment cases look specifically at 2 types of investments. So high density, which was sort of 8 floors and above or higher buildings, which is in more urban locations. You might think like Embakasi, even Kahawa, these types of places. And then medium density models. Medium density models are ones that you might find in suburbs. We still find kind of buildings at 4 or 5 floors here in within Nairobi, but you'll see more and more of the new development within the city is higher density. Further outside in peri-urban locations are becoming more lower density or medium density, let's say, not low density, medium density. This is where we are hoping to continue our engagement with the pension sector. This is just the very start of our engagement, working with the pension sector to understand opportunities in the sector. We want to be able to now walk you through financial model tools, investment processes, the details and the fine assumptions that are used in terms of understanding good affordable housing investment projects and how you structure those investments. And so after this initiative of education that we're engaging with KEPFIC on and the pension community on, we are hopefully then going to move into a phase of engagement where we will be open to working with various pensions on continued education, deeper education engagement, where we can help you understand how do you financially model and understand those investment opportunities. We're also looking to support the fund management community because we recognize that not all fund managers have expertise in property. And so we're hoping to lift the capacity of the sector through some of this work. Now, this talks a little bit about how you can mitigate risk and what you can look at. What I'm going to do is I'm going to talk about risk mitigation just in the last section here, as I work to try to finish this presentation up by 10. Also here, in terms of now, what is the changing dynamics that we can expect to see in the sector? Because as you see right now, we're seeing a major housing shortfall. Over time, like Atia pointed out, those 500,000+ units from the public sector is working on with engagement with the private sector. There's also private sector driven programs that, tally up to hundreds of thousands of units. We're going to see a changing landscape within the city. We're going to see greater densification of central parts of Nairobi, for example, through projects like Railway City or Eastland's redevelopment program. We're seeing new housing finance products enter, like we're talking about how now SACCOs are able to lend, or more DFIs investing in housing funds or whatnot. And the entrance of more institutional developers, international developers that see the opportunity here in Kenya, that think that they can engage here and work at scale here. Lastly, on real estate investment risk management. So as you're investing in projects, you always want to manage and understand the risk. Now, this is an area that we're also hoping, as we engage with the pension and fund management community, to help to understand how to address issues of risk, as it is through due diligence, as it is through contracts, as it is through selection of the right partners, as it is through even how you structure your investments. All of those things can really address risk. And where does risk come from in real estate projects? Early in the process, for example, like in permitting, you have the greatest level of risk. If you don't have permits, you don't really know what you're allowed to build on that plot. Once you get that moving now into construction, you get another wave of risk, because delivery of construction, financing of construction, that has a different level of risk, but you can see the risk level is coming down. Then you get up to the lease up period. Now you have an asset already, so your risk has reduced substantially, but now your risk is all around your NOI, your net operating income. Where are you going to get your income? Are you going to be able to get your occupancy? You drive your vacancy down to the right amount. Are you going to get the rental prices that you're looking for? Are you able to manage the costs of managing your assets, your building, over time? And this is where we move it now into the stabilized operations. Now, these are general figures in terms of percentages of risk. This is generally meant to show us and illustrate to us where in the development process there is risk. Then, if you know where the risk is falling, you can then appropriately make investment tranches at those phases. So, for example, if you're in the permitting process, you might say, okay, well, we're only going to invest in a project once that has permits. And then at that point, you're focused on the construction risk and therefore and going forward. Or you might be more opportunistic and say, okay, well, I know I'll get a better deal if I put in a small amount of money, maybe like 10, 20 million to advance a project to the permitting before you now make the bigger investment of the actual construction. So this helps us guide where along the continuum. And there are different risk strategies, risk avoidance, so avoiding perhaps poor developers or organizations that perhaps cannot fulfill the project's lifeline because they have a bad track record. Risk anticipation, where you might know, okay, well, you might expect some issues on site with contracts or on construction because of issues you don't know underground. So you do risk anticipation by doing geotechnical surveys or additional studies. Risk transfer, where through contracts you transfer risk to contractors or developers or different different sort of parties. And risk reduction, this is where you might say, okay, well, we see the risk. We want you as a developer or you as an architect or you as a contractor to do 1, 2, 3 to reduce the level of risk that we might be having in this project. Now, specifically within risk, there's different risks you can have when it comes to the yielding side of risk, when it comes to making an investment and getting the yield. So let's say if you're investing in an existing building, there's ways to manage the risk, whether it be from the cash flow, managing your expenses, through valuations, through the disposition? How can you manage some of those risks? These are all risk strategies that you can look at over time, or it means through the construction process. And this is a methodology that we use at iJenga, but just to talk about the overall process of development, feasibility, financing, design, construction, offtake, asset management. Where can you insert different risk management strategies to help to reduce the risk? So with that, that was today's presentation, and today's presentation really was meant to be a high-level introduction to the affordable housing sector as it relates to the gaps in the market, some of the challenges we're experiencing in the market, some of the trends that are occurring in the market. Then we wanted to talk a bit about how can investors invest in the sector, and specifically pension and institutional investors. How can you think about investment through products, through different opportunities, and then how can you manage some of those risks? As mentioned, we are going to be engaging with the pension sector on an ongoing basis through KEPFIC and any other organizations that work with us in the pension sector. And so we are open to dialogue and engagement. And as we circulate this presentation, I'll make sure our email addresses are in there for the task force. So we look forward to hearing from you. Now, we're going to move into the panel, section of today's discussion. We're really excited to have very high-level panelists join us today. Very excited. We managed to get a hybrid of people from the pension, from the fund management, and from the development community. And the first person I'd like to introduce, and I'll ask the panelists to join, showing their video and join for the Q&A session now. And during that Q&A session, please feel free to put your questions into the chat box. I'll definitely be looking at the chat box. I see already there's some comments. Excited to see some of this. We've got Stella from NCBA. We have James from the Capital Markets Authority. I see James is talking about how CMA is also focused on affordable housing. So I think we'll be excited to engage with you, James, on the affordable housing agenda. Now, I'll first introduce our first panelist, Azmina Banji. She's a developer. She is the Regional General Manager for Real Estate Development at PDM. PDM is a well-known and recognized real estate development organization in Kenya and operating across East Africa. And they have done projects in housing as well. Thank you, Azmina, for joining us today. The second panelist. Thank you. The second panelist we have today is Ruth Okol. She's in the fund management, but also actually an investor as well. She's an asset and portfolio manager at the Fahari REIT that is owned by ICA Lion. Hi, Ruth. Great for you to be joining us today.
Thank you very much.
And our final panelist is Joseph Rono from the pension fund community. He is the Director of Strategy, Finance, and Investment at CPF. CPF is also doing a lot of work in the affordable housing sector. So we're very excited to have Joseph here today.
Thank you, Zarafan.
Thank you so much. Great. Well, I'll just jump right into some of the questions here. We've got a great lineup of questions. I'll start first with the developer, and then and we'll just kind of go through between developer, fund manager, pension. So between Azmina, Ruth, and Joseph. The first one I'll throw to you, Azmina. What are some of the opportunities you're seeing in the affordable housing sector as a developer?
Well, I think you've already touched on this, Saurav, you and Gata both. There's a huge deficit, right, of 2 million plus houses, especially in the low income sector. And Gata touched a bit on also the fact that even with the supply of 50,000 houses a year, only 2% of that is touching the low income sector, right? So there's a tremendous opportunity for developers that are willing to deliver value for money. And again, you've both touched on this. It's really, really important for us to make sure that the housing that is developed in the affordable housing space is of excellent quality. You know, it has amenities, a good living space, and of course, environmentally responsible housing. So there's a tremendous opportunity we're seeing, and not just within that, the definition of the Big Four agenda, which is like housing from 1 to 3 million. But as PDM, we've done a tremendous amount of research, and we're seeing even from the 3 to 8 million range in selling price, that there's substantial demand. And I guess you would call that more not low income, but affordable middle income. But we're seeing tremendous opportunities there as well.
Yeah, thank you, Yasmina. Very well put. You know, that's an interesting segment. We often talk about sort of the low income segment, but even the middle income households, you know, some of those ones are the ones that suffer from long commute times, far distances. You know, even their pricing is not affordable for them. So thank you so much. And Joseph, I'll ask you the next question. You know, what opportunities are you seeing? And I'm excited for you to share a bit about what CPF is doing. I know some innovative work with counties as well.
Yeah. Thank you, Zurafa. Indeed, I think there's a slide which you projected, which I think says it all in terms of the dynamics of the housing in the market. And you can see 60% is actually in the low income. Of course, 18% is on the social housing, which is down the lower part of the pyramid. But there is also, I mean, the middle income who are also in dire need of housing. So if you look at this 2 million housing deficit that we're talking about, I mean, the biggest chunk of it really is actually in the low income space. And this explains why you see there are a lot of units which has been rolled out in the market, but apparently it's targeting the high end part of the pyramid, where the demand is now shrinking at a very alarming rate. So for the case of pension funds, this is a space which our CPF, we want to participate in. We already have a pipeline of projects which are basically operating on the affordable space, which we believe is going to plug into this huge deficit which is there. So there is a huge opportunity, both in the public and the private sector. And Zorofa, you'll also need to take into consideration that we now have counties which are really other institutions which have pulled in large population that requires housing, and that is the space which we really want to participate as CPF.
Wonderful. Thank you so much. You know, I think you highlight this interesting group of the county. Often we think about the national government, the State Department of Housing, and its programs, but the work on the ground is happening within the counties. And I know that CPF is working on some interesting initiatives with counties. So perhaps you can even share some of that as we go into the sessions today. That's really great.
Yeah, yes, indeed. We are already partnering with counties. I mean, this is the best thing that we can give to counties. We have people who live in the counties, but many of them, of course, live in the major cities like Nairobi. So every morning they drive all the way to their counties. And this is majorly because of a shortage of quality housing and other amenities like good schools and all that. So that is the gap which we are currently trying to plug in. We already have signed partnerships with around 5 counties to start off with a potential investment of close to 2 billion Kenya shillings across all those counties. So we strongly believe with the rollout of that kind of investment, number one, we believe we are going to meet our investment objective as a pension fund. And at the same time, we are going to address this acute shortage of houses, especially at the county level.
Wonderful. Thank you so much for sharing that. Excellent. Ruth, the fund manager plays a very important role between the developer often and the pension. And so that kind of middle person role is very valuable. You know, in that seat, what opportunities are you seeing in the affordable housing sector? Oh, you're on mute, Ruth. You're on mute.
Sorry. I was just saying thank you very much, Zorava. So I guess I was too excited to speak. So just for the beginning, the fund management is really in between the investors, the owners of money, and of course, our job is to really manage that money for their benefit. So we do manage a lot of institutional funds from pension schemes, as Mr. Rono has mentioned. We also manage funds from insurance companies, high net worths, endowment funds, and so on and so forth. So really, there's a lot that a fund manager can do within the real estate space and also affordable housing space. Of course, as a manager of funds, we chase returns. And these returns are either, of course, yield. You've talked a lot about yield in your presentation. But we also chase social returns, which is really how a fund manager then ensures that the investments they make have also impact on the communities within where we invest, and hence also the big question around sustainability and all that goes with it. So in terms of investment opportunities, we have a lot, and we invest according to the strategies, investment policies of each funds. These are third-party funds, so each of them have different objectives. So we invest according to that. So if I narrow down to pensions, for example, we do invest for pension, and there are many ways we can invest for pension monies. And talking about, I think there's a slide you had where we talked about at least about 70% of pension AUM being able to be invested in real estate through different vehicles. So maybe I just run down those vehicles in a few seconds. So the first is direct investments, where we can invest the monies of pension scheme directly into real estate, into housing, and Rono has also touched on that. This is equity investment. Then we can also invest in real estate indirectly, which this is where real estate investment trusts then come in. We also have debt. Probably you've heard about green bonds recently, like the one for Econ. So fund managers are also able to invest in these housing schemes using debt through bonds. And I think there's also IHS, which is also a debt opportunity. So those are the key areas we can invest in. So private equity, we can do direct investment. We can also do real estate investment, property funds. Also, we have now partnerships. We can partner with the other developers and invest in real estate. And we can also do what's under the LLP, limited liability partnership. There's a lot of opportunities for investment, a lot of products for investment in affordable housing and real estate in general. Thank you.
Yeah, very helpful, very helpful. You know, what brings money together with an operator or developer is the product. And you did a very good job in helping us understand the different types of products that exist within the product landscape there. And being also a developer myself, I appreciate the value that each of those products have. For example, like the equity investment, if I don't have enough equity for my project, an opportunity fund or a pension fund can come in and help add more equity. They can also benefit from those developer returns. And those developer returns are normally higher than things like the yield and whatnot. So it's a great way to make a good return. Similarly, with a REIT, right now in the market, if I build a building, there's no way for me to go and sell that building to the market because there's very few buyers, institutional buyers in the market. Pensions are starting now more and more to also pick up buildings. We've seen that Delta Towers, for example, owned by pension, a number of buildings owned by pensions, and we're seeing some trading of assets. But the REIT structure and having an active REIT market is another way that we can see pensions and other institutional investors holding real estate. The other benefit of REITs is that when pensions own the asset directly, they hit that direct investment threshold. And REITs helps them also manage the amount of threshold there. So I will come back to you again, Ruth, and ask a little bit more about products, about where we can see more. But let me hand this over to Esmina and ask her, out of these products that we just discussed, in terms of things like the developer's equity investments, things like having the offtake, how do you see it as a developer being beneficial to you? And what would the developer want to see out of those types of relationships, that engagement with the investor?
Thanks, Saurav. I think you've already touched on a bit of this, you and Ruth both. For a developer, obviously, equity is what drives our business, right? And so when we can partner with a solid partner that increases our capacity, de-risks the project for us, so that we have the capacity to do more projects, right? If we have a good partner with us. I think also one of the issues, one of the benefits of partnering with a pension fund, for instance, is that what we've found in the industry so far is that within this lower middle income bracket, most of the occupiers are renters, right? They can't afford to buy. So like you said, if there's a pension fund that's willing to purchase the property and put it out for rent, that kind of offtake also de-risks the project significantly. If there's a forward purchase agreement, that again adds to the de-risk profile of the project for the developer. I also, like you said, agree that investment in REITs, again, it will help us build capacity within the affordable housing space, right, to deliver on covering this huge gap in the housing needs of the population of Kenya.
Absolutely. Yeah, Azmina, you touch upon something really important there in terms of when you say de-risking and capacity. So one thing we know about local developers in the market is that their capacity for equity is not so big, which is why historically we have seen them use down payments and unit purchase payment plans to help augment their developers' equity. And that has come with a number of challenges. Projects maybe not finished, where the unit purchasers are maybe unhappy. And so having a pension or a equity investor alongside a developer really does de-risk projects, like you rightly pointed out. The other point that you made on capacity is also very important, because we are seeing that if you need to bring in affordable housing within a certain cost structure, right, within a certain price point, you need to often to build at scale. You need to be working on larger sites, phasing those sites, and that scale is not something that local developers have the capacity for. So I think you mentioned really two important points there around de-risking and capacity. And I want to ask Joseph, as we talk about investment into housing, as we talk about the different products that are there, what are some of the products that you have seen either CPF or your other pension colleagues be comfortable with? Because Ruth had pointed out a number of different products, all for different purposes, and they're all very valuable. Often we find education leads us to one or two or three products. What are some of those products that you're finding that are beneficial for the housing sector through pensions?
Yes, one of the key products which probably will be beneficial to the housing sector, which I believe pension funds can actually participate, especially based on the fact that pension funds hold what we call long-term funds. You have this new employee recruited at the age of 25, he still has 35 years to work. So the question is, what do you do with his money? So if you look at some of the demands coming from even the membership of the various schemes, housing is top of the list. So in this case, it should actually be possible for even pension funds to structure products such as tenant purchase schemes, where schemes can help members access housing by developing houses which they can sell to members and even other people from the public, and then have an arrangement where that house is being paid for over a long period of time. In other words, you will have kind of assisted that particular member to do what we call is kind of rent to own. In other words, it's kind of paying an amount on regular basis, which is not far different from an ordinary rent, which you would have paid for. So those are some of the products which the pension funds can participate in. you can structure a TPS product running over a period of, let's say, 20 years. So which means you are guaranteed that on regular basis, you'll actually be receiving income, which really become an alternative investment for the scheme. And then, of course, Ruth talks about other investment vehicles such as private equity. And for the case of our market, we have an example of IHS, which has come into the market with an objective of rolling out affordable housing. So as a pension fund, we find it really fitting into our strategy to participate in such a fund, because it's end of day, it's going to address the housing deficit that we are talking about. And in this case, we can even mobilize our members, for example, to participate in a purchase of houses done by such developers. So there are quite a number of vehicles available for pension funds to participate in the housing sector.
Yeah, thank you, Joseph. I'm going to keep engaging you here on these two, but I just want to make a comment on these two you mentioned. Really, really great, sort of bringing up tenant purchase schemes. This is something that I think we saw some years ago through government housing. They implemented tenant purchase schemes, and then we saw a gap in the TPS, for a number of years. But we're starting to see a revitalization in the discussion of TPS. Really beneficial to households, because you're paying a rent-like payment, but you're accruing equity in that unit over time. It's beneficial to the asset holder because you don't transfer title until the end. So meaning that if you have a default, if someone is no longer able to pay their rent over whatever period that is agreed, then you still own the asset. You have not transferred the title, so you don't have to go through a lengthy, complicated foreclosure process, which is very beneficial. So that's really, really great. And I like how you mentioned private equity, and it's really, really excited to see IHS in the market, because it really helps to support developers by bringing that capacity, as Azmina pointed out, the capacity alongside investments. But from a pension perspective, it's exciting to see pension now invest in private equity, because you see private equity, or those fund managers, are they have expertise in making those investments. So you can benefit from the returns that come from development returns, but you don't have to hire the people in-house. You don't have to get integrally involved itself in those projects. So those are really beneficial to have those kind of schemes there. I want to also, Joseph, as I have you there, and I know Ruth, I like how you turn your camera on, because I'm going to come to you next with actually a very similar question. So prepare your answer. And this is the big elephant in the room. When we're talking about whether it's TPS, whether we're talking about rental, we are having a yield conversation. We know housing yields can range, depending, 8% to 12% normally, and often we find higher end housing yields are even lower, 4%, 6%. So when we have a yield that is lower than our risk-free rate, how do we manage this situation? I mean, from an economic standpoint, it seems like a challenge, and that's why we've been seeing so much money go to treasuries. How can we think differently about this? What do you think?
Yes, I think that, as you said, that's the elephant in the room. But if you look at what is the reason why the rental yield on properties is a bit low. So of course, it's a factor of the value of that property. And if you can joggle your mind for the last few years, I think other than the last 3 years where the property prices has been fairly flat, I think around 5 years before that, there was a real rally in terms of the valuation of land, valuation of properties and all that, which has a huge and a significant impact on the yield of the property. So the strategy to really get a better yield than treasury bills, for example, is when you develop the project yourself and you embed in a number of strategies to make sure that you are rolling out the project at a very, very affordable cost. So which means you're able to lower the value of that property. If you are to use that property, for example, for purpose of rental, then the rental yield at the at the entry point, at the point in which you are entering that property at cost, the rental yield will be very attractive. But then, of course, over time, issues of capital appreciation will come in, and definitely the value of that property will escalate with time to the effect that when you look at it long term, the rental yield, of course, will keep getting depressed. But the best thing to look at it is you look at it from the IRR perspective. Are you able to get a better internal rate of return of the development or of the property which you've purchased compared to the rates which is offered by Treasury bill? So I think that will be a more objective way of looking at it. So it's always good to get advisors like the likes of Ruth and many of our fund managers, so that when you are entering into a property investment, you're able to look at it critically in terms of what kind of IRR is it yielding. And in most cases, it will be yielding a better internal rate of return than the Treasury bill rates, which are there in the market.
Fantastic. Thank you. Those are really, really great points. Before I comment on some of those points, because they're all so good, I want to give an opportunity to Ruth to also share a bit as well.
Thank you, Zarava. I think Rono has captured it very, very well. We are always having this yield discussion. Every time there's an investment team meeting, we're always fighting about yield. And I think it feels just easier to invest in, simpler assets like IFBs and move on. But I want to just bring in two aspects. The first one is yield optimization, and Rono has touched on that as well. We all know that for you to be able to improve the value of your assets and the shareholder value, you have to do an optimization, and that is how you manage your cost and how you also improve your revenue side of things. But also development is very, very key to improving any property portfolio in terms of the returns. Thinking also differently is that property is a long-term investment. So it is not something you enter into today and in a year you want to come out. So you have to look at it very long-term, and you look at it from a total return perspective, which is also what Rono talked about. So you're looking at your rental yield and you're looking at your capital appreciation. Yes, there are years that the appreciation will not be there. It might be zero, as Rono has mentioned, it's flat over the last 3 years. There are years it will go down, so you will probably get a depreciation. But when you draw a graph, a line of best fit over a period, let's say 10 years, you will always see an appreciation, a very smooth appreciation over time. So you look at it from a total return perspective. And the other thing is just that property has a very low correlation with other asset classes, and it gives you a very good diversification strategy. So what that means is, yes, the bonds today are trading at a very good yield. If tomorrow the interest rates go up, then your bond values immediately, you mark to market immediately. If tomorrow the equity market had an issue, your shares prices will basically take on that immediately. But for property, it will take some time. And because of that illiquid nature of property, and because of the low correlation it has with other asset classes, then it gives you a very good diversification option. And also it gives you a long-term cash flow, as Rono has mentioned as well, and also the total returns over a long-term period. So I think the key thinking strategy here is look at it from a long-term perspective and look at it from a total return perspective. And then the comparison then will come in, and you will see that over time, property actually performs better than most of the other investments. Thank you.
Yeah. Wonderful, wonderful. Thank you both. Thank you both. This is like an age-old question we keep getting over and over again. But today, I think you have done an excellent job, really, really helpful job in explaining and unpacking ways that the investment in property can actually perhaps even outbeat what we're seeing in the Treasury, and even different ways to think about it. Thinking about it from an IRR perspective, thinking about it being not correlated to the general market. People will always pay their rents. You'll see very lower dips when you see recessions. And I'll add up a couple of additional things, because those are really good points. I'll add up a couple of things. One is around education. Educating the fund managers, educating the pensions, because you see there are ways to make those yields and make those returns, but it takes education. And sometimes it's easier just putting it into a treasury. But once we engage and educate the market, it is, and the pensions and the fund managers, we'll start to see more movement. And I think that we need to continue to do our education. I'm sure, Joseph and his team at CPF has had to educate the trustees over time, educate people. It's an ongoing journey. And that requires a lot of effort. But, when we have leaders like yourselves here that are willing to invest in that process of education, it really transforms the market, because you are the market leaders in this space. One other comment I'll also make that sometimes doesn't equate into our financial computations is the social impact. Now, I showed some pictures of housing that we see in Nairobi on the presentation. And we don't want our community members in Nairobi to have to live in those situations. We want people to live in dignified housing. We want people to feel safe and comfortable in their housing. And it is a kind of a great almost responsibility that we have to see how we can figure this out to bring it about, because the people that are living in those situations, they need us to figure these things out. And it's a way that we can help build our society in a productive, positive way. So there's a lot of positive that comes from investing in housing as well. And I'll make one other comment that I know my colleague Yasmina here is quite a bit out, being on the board of Kenya Green Building Society. The cities emit 70% of the carbon emissions in the world. And of that, a large percentage of that comes from buildings. So as we think about the social good we are doing in this, if we design green as well, we can have a lower carbon footprint on the world through the work we're doing. And, as it relates to money and capital, there are many concessional fundings. Ruth, you mentioned green bonds as well. There's other grants funding, all those forms that help us even reduce the overall cost structure potentially, which comes back to Joseph's point around really thinking about yield on cost rather than yield on price, yield on cost. And that's where a pension can come in early, invest into the development, perhaps alongside a developer, and then pick up that asset on the back end, and it's getting in on the ground floor, and and it's getting it for a good price. So those are all really, really good points, and thank you for kind of digging into that a little bit, because I know it's a big question that we see. So I want to ask another question for Ruth here. Is Ruth, like we talked about, the intermediary between let's say a pension or a source of capital and a developer is the fund manager. And the fund manager also needs to advise on investment decision-making for a pension, I believe. Can you explain that a little bit and explain what you might think the fund management community might need from a skills perspective? Like, because we understand not all fund managers have real estate teams per se. ICA has a deep expertise in real estate, having done other projects previously and whatnot, but maybe other fund managers don't. So maybe talk a little bit about the role of the fund manager in the investment making process, and then what you as a fund manager might want to see in the sector to upskill some of the fund managers, please.
Yes, sorry. Yeah. So I think the role of the fund manager really is to take care of the monies that have been entrusted to them by the various investors. And as I mentioned earlier, is that these are most of the times they are third-party monies, and they are managed according to the specific mandate. So if I'm managing for a pension scheme, for example, I'm thinking long-term, I'm thinking matching the liabilities, I'm thinking matching the liabilities obviously with the cash flow. And I'm thinking this money has to be enough until the last person in the scheme is paid. If I'm managing funds for an insurance company, depending on whether it's life or general, if it's general, I'm thinking very short term. I need to be able to have money that should be paid immediately, should there be a claim. And I'm thinking a maximum of 1 year investment horizon. So different owners of money, different mandates. But at the end of the day, we have to grow the shareholders' value, and we have to be able to give a return. So in terms of, and you're very right when you mentioned that not all fund managers really have a property, a fully fledged property expertise or with in-house. And a lot of time we rely on external parties. Even for those that have, it's probably not fully fledged. I think it's Ngatia's presentation where he outlined all the parties that are involved in real estate. And real estate is really a very intensive investment. So it requires a lot of expertise. So one of the things that as fund managers, we really want help with is, just that capacity building, because we cannot afford to have all the capacity in-house. Things like doing research, things like getting proper numbers that we can rely on, as you mentioned, things like simple things like yield you can get from 5 to 12%. So as a fund manager, you are lost saying which one is it? So things like valuation, things like, just proper advice, proper research, proper numbers, because we really we like dealing with numbers. And we say numbers don't lie. So if the numbers are not making sense for us, then we're not able to make that investment decision. The other support we need is obviously from what I would call enabling environment, which I think a lot has been done, especially on the regulatory front. We've seen a lot that has come through. We've seen the mortgage regulations for pensions have been revised. We've seen a section of property law. There's quite a lot that's supporting tenants, supporting landlords, like Section of Properties Act was just revised the other day. And a lot of property law is being revised. So that is coming up very well. And I think even our REACH regulations are very, very good and benchmarked on global best practice. So there's a lot that has come through from that front, but there's a lot of work that needs to be done, especially from education perspective, awareness creation. Where are these opportunities and how do we match these opportunities with the investors? Because a lot of times in our offices, we don't know what's happening out there. So someone needs to be able to come and show us those opportunities and then show us what is in it in terms of investment. And then we'll be able to match those opportunities with the would-be or the respective investors. So a lot of education, a lot of awareness is very welcome. There's a lot of space to really interact. And also just a lot of appreciation about new products. I think most of us are also very risk averse, probably you may have seen. And why I'm saying that is, if I look at Zamara report, they're saying that only 10% of the pension schemes that are participating, and there are over 400 of them, they've only invested 10% of the AUM in real estate. And remember, you talked about 70%. So we still have a gap of 60% to fill. So we need to get out of this fear, and someone needs to help us, handhold us to get out of that fear, because most of the time it's just because we don't understand the whole project, the whole process, the value chain. And we don't understand, it's very difficult for us to relate to the investors like trustees and be able to convince them that this is really a good investment opportunity for them. So that capacity building, awareness, and enabling environment is very key to enable fund managers to make the right decisions and show the right opportunities to the different owners of capital.
Wonderful, wonderful. Thank you so much. And as I pointed out in the presentation, that this is a part of an initiative around building capacity in the sector. And so it's really a program, and you know this firsthand because you sit on that initiative at the task force, Ruth. And I see other colleagues as well on the call, and I'll just also highlight them. I see Vivian Obiambwe from Brole. I see Ken Masika from Masika, Lloyd Masika. They're also sitting on this specific initiative for increasing pension capacity and increasing fund manager capacity, which is really great. I'll also give a small shout out to some of the other people on the task force as well. I see Stella's there. Hamesh is on the call, I see as well, a past board chair of KPDA as well, and also sits on the task force. So, we've got great representation today. I'm going to do one last round of questions for everyone, and then I would love to open this up to our really wide range of audience today. I know we've got investors, pension fund managers, developers. We've got a really good wide array today. So please feel free to get ready to ask questions. But I'm just going to ask maybe one or two more questions before I before I open it up. Azmina, the next one is to you. And we're going to talk a little bit about, how you have seen investors augment risk. But before, Azmina, I'm just confirming, are you there? I just see, maybe you can turn on your camera.
I'm here, Zarva.
Perfect. And I want to talk about, how you have seen firsthand how we can, as developers, look at risk, or how pensions can understand risk. But before asking that question, I want to ask you, if you wanted to reach out to a pension, would you know how to reach out to one? Just out of curiosity. Like, would you know who to reach out to, how to reach out? Like, would you know how to maybe get in touch with Joseph or some of the other pensions we have? Does it seem straightforward?
No, it's not very straightforward. Of course, we have our sister company, Jubilee, so most of the time we're reaching out to Jubilee Insurance. But no, I think we've identified some, but in all honesty, it would be good to have some kind of matchmaking, and maybe KPDA can look into that as well, to be able to connect developers with pension funds.
Yeah, thanks. That's, I know that was an impromptu question. And and it just struck me. I'm like, as a developer, it doesn't seem very straightforward. Although I'm sure pensions are seeing projects often, but there's so many more projects probably that they could be looking at if there was a channel or an opportunity or a way for them to look at projects. And it's a really good point you make. And you're fortunate being within an Aga Khan institution. You have different sister agencies. But a lot of developers are smaller and they may not have the access. So yeah, thanks for that. And thanks for pointing out how the KPDA can get involved, because you are also a task force member. So that's great. We're doing a lot of promotion to the task force today.
No, but absolutely. I mean, where else would you go, right? Where else would you go to look for that kind of facilitation, right? To make those connections. I think the KPDA is the best forum for that. I think also that you made a good point on education, right? Because I think, development is very risk fraught and very complex. And for anybody that's not a developer to invest in development, they need to understand what those risks are and how to mitigate those risks. And I know you had some slides on that in your presentation as well, but that's extremely important to educate them on how to do that.
Definitely. Well, I mean, that's a good segue, actually. I wanted to kind of ask you from a firsthand perspective. I know you, PDM has done a number of projects where you have had to manage risks, whether it be with partners, whether it be with contractors, whether it be off-takers, the whole continuum. When you're a large developer like PDM is, you see the whole world of issues. Maybe you can just touch upon a couple of risks that you see as key risks and ways to either avoid them or mitigate them, from your experiences.
Sure. So I'm going to talk from a developer perspective first, a developer that doesn't have an investor partner, right? I think, again, you mentioned this in your presentation, is that risk needs to be managed from the very beginning, right? So having a solid business case that's supported by market research, right? Ensuring that your project controls are in place from day one. So how you manage time, because time is money, how you manage your project budget once it's been approved from the very beginning to the end, how you manage the design phase to control the scope of the project so you don't have your scope running away from you, how you mitigate risk with development control and approvals, right? Beginning really early with your dialogue with the county or whoever you're dealing with on development approvals and permits, making sure your construction contract is airtight. And we've had lessons learned from risks during construction, and we've been able to incorporate a lot of contractual language that protects us from some of the risks that you can face during construction. One other area that I would touch on that's really important from a development and technical perspective is ensuring your design is as complete as possible before you start construction. And I know, again, we developers like to rush into starting construction. So, we want to do it as soon as our schematic drawings are done and approved by the county. But detailed drawings and interdisciplinary coordination between your structural, your architectural, your mechanical, electrical is really important. So those are some of the risks in the process, in the development process. And then, of course, having a robust marketing strategy, pre-sales, controlling timelines during construction. Those are, other areas where you need to mitigate risks. So.
Great, no, very helpful. Those are very technical and tangible, very specific things,
Right.
Yeah. Good. Well, wonderful. I want to open it up to the audience, and you can either post your question or even unmute yourself. Even that's good and easy. Just feel free to unmute and put your video on and introduce yourself and then ask your question. Before I sort of just kind of give some space for that to happen, I do want to just kind of highlight a couple of things that we heard in today's panel that are really valuable, things that for all of us to think about and consider, and that we're certainly going to take away as ways to build upon this program for educating the fund management and pension community. One is around the capacity building, and I think that was specifically around the fund managers. That was a really good comment that was made in terms of how can we help educate them on understanding what the dynamics are of the sector, and also how deals and products can get done. The matchmaking, I think Yasmina made a really good point around matchmaking, and seeing how platforms like the Affordable Housing Task Force can help bring projects to pensions. And we do have a capacity building program that has an opportunity that shepherds projects through a program that helps them make sure that they're institutionally investable. So maybe bringing those projects to the pension community. Joseph really did a good job of articulating the value proposition vis-a-vis, and with Ruth's support there on vis-a-vis some of the treasuries. So, being able to articulate that, so, not everyone, it may be making it easier for people who are working at the pensions to educate the trustees and advocate for housing. And then lastly, on risk management, we would want to see these projects being successful. We would like to see deals getting done. And really all that comes down to is risk and return. So if we can help mitigate and understand risks better, we might be able to really, see more deals getting done. So maybe that's a part of the education program again as well. Let me open up the Q&A now, and just feel free to turn on your camera and just introduce yourself. And okay, I see Peter's there. Peter, you wanna go ahead? It's good to see you. How are you doing?
Yeah, thanks. Thanks to Zorova. Actually, I don't have any questions. Just to say thank you so much for KEPFIC and KPDA putting together this forum. I'm Peter Mayavi. I'm the managing director for IHS in Kenya. A lot of you have heard about IHS, and we are partners with CPF. We are partners with Zorova. And as well as KEPFIC as well. And we'd like just to thank everyone for making time to attend this. We are a private equity fund in Kenya. We are investing in affordable housing. We have quite a veritable pipeline. As well, also to mention to the pension members here that we're still fundraising. So if any of the pension members here would be interested for us maybe to make a pitch, we are available and ready to do that, as well as the fund managers as well. I'd just like to take this opportunity that if you can get in touch, even through Ngatia or through Zorova, I'd really appreciate that. Thank you very much, everyone.
Thanks a lot, Peter. Thanks. And we're excited. IHS is making traction in the market. And we're excited to see them grow and invest in more housing projects and see more projects come to market. Thanks a lot, Peter. Anyone else have any questions or even comments? That was a nice one. I see as we're waiting for people to kind of ask questions. I see a question here in the chat box. It says, has KEPFIC or Kenya Pension Funds explored opportunities in the financing of affordable, purpose-built student housing? So I'll just, maybe Gatia can kind of talk a bit about some of the KEPFIC programming as well, because that would probably be interesting to people. But I just want to quickly mention one that it came to mind during the conversation today when Joseph and Ruth were talking about investing in development and then also getting the yield. There is a student housing developer called Acorn that has come up with a interesting D-REIT, I-REIT proposition, and I think also has raised something like 3 billion from the pension community. And we are excited also about that that sort of platform, because it helps to bring REITs out, and it's a very innovative one because it's the first time we're seeing the use of D-REITs in the market. And so the D-REIT, I-REIT combination also helps to increase returns to the market because the yield side has a lower return, the development side has a higher return, so you blend the returns and it's a blended return that's higher. So that's one. Gatia, it'd be great for you to maybe say a few words about KEPFIC, and then I see Frederick Zui has his hand up. So after Gatia speaks, then we'll take Frederick's question.
Absolutely. Thank you, Zorav. And that's a great question. Yes, KEPFIC is looking at purpose-built student housing, and exactly how you mentioned it, through the only developer right now, the only opportunity that we have seen thus far, at least institutionalized, is the Acorn REIT and the Acorn Green Bond. Acorn and KEPFIC are in the process of putting together various engagements and roadshows directly with pension schemes and their fund managers. The good thing about what we're doing now is at least with Acorn, and it's very similar with, I'm sure it could be very similar with a lot of other developers, is right now we are able to show, or they're able to show their track record, their performance in the last couple of years. And remember, I mentioned that as KEPFIC, we're looking for de-risked opportunities, opportunities that we can that have some form of a track record that we can then assess. Because it's totally understandable that our membership are quite conservative in nature, and so would prefer not to be the first movers in a lot of cases, and would want to see how the investment has performed before coming in. I also just want to appreciate the words that Peter Mayavi has just spoken, and just to encourage our membership and everyone on this conversation to reach out to us, and we would be very happy to set up discussions and one-on-one conversations with the team at IHS. I just want to highlight that one thing that has really come out of this conversation is that there are multiple routes to getting affordable housing, or getting housing or real estate exposure. There's a direct route where you actually build, and we have heard about yield on cost, for example, which is a good way, great way of looking at it. But then there are also alternatives. There are private equity funds like IHS. There are the REITs in the market, like the Fahari I-REITs. And so we are fortunate to have multiple methods to get this exposure. And we as KEPFIC are here to help members, are here to help the pension scheme think through those different options. And probably lastly, I mentioned a comment that was made by Azmina about capacity building and matchmaking. That is exactly what KEPFIC was formed to do. KEPFIC was formed to bring the pension fund community together with the opportunities that are out there. And so our partnership with KPDA in this regard is extremely powerful, and it's something that I think you will see going from strength to strength, especially following this type of engagement. Thank you.
Thanks so much, Gatia. Yeah, and I just would echo the collaboration and the power of collaboration, particularly as we're going to see it now with KPDA and KEPFIC increasing, and we're really excited to be working with KEPFIC on bringing projects to the market and seeing more uptake of affordable housing. So thanks so much, Gatia, for some of that background in KEPFIC. I see Frederick, your hand is up. You want to please feel free to unmute yourself and even turn on your camera, introduce yourself.
Morning, Zova.
Hi, morning.
This is Frederick Nzui from Kenya Airways Staff Development Fund. We've been following the conversation this morning, quite interesting. Really appreciate KEPFIC, led by Ngatia, in terms of putting together this webinar. Great insights. And from where I sit as a pension fund, we're very keen to occupy the space on the demand side, especially given that our members are very keen on getting the home ownership up and running, given the new recent regulations. My question, by and large, is we're running a housing survey this week, and you're basically looking at first-time home buyers in the market who might not have so much in terms of pension savings. However, what is your speak to the build to rent and rent to own? I think we've had a discussion around the tenant purchase. So I just want to pick your mind on how that space is evolving, so that some of these members who don't have much of that accumulated savings would eventually be able to have affordable rent and eventually have a rent to own outlook, and how the institutional players like IHS and KEPFIC are playing in that space to enable these members afford their homes in the long run.
Yeah, thanks a lot. Thanks. So firstly, Frederick, really great to hear about the pensions interest in housing, and as I mentioned, we're kind of going through this process of education and then engagement with likely a smaller group of pensions and fund managers, very direct engagement where we can help support the capacities and share some of the tools and resources we have. So we'll definitely put your name on that list, and thanks for asking that great question. I'll maybe make a few comments, being in the housing space myself, as wearing my iJenga hat kind of as a developer, but also, it would be great for Asmina and Joseph and Ruth to also comment. I personally think that there's a tremendous opportunity in rental housing. And I'll start by saying that by asking a question to say, how many institutional rental housing companies or organizations do we know of here in Kenya? I personally cannot think of a single one that is known as a branded operator of rental housing. If you go to other countries in the world, you'll find Toronto Community Housing, which is a PPP. They manage something like 40,000 units. You have in the UK Places for People, they manage over 220,000 units. You have in other parts of the world, you have owners and operators, or even just operators of large scale housing programs that are managing rental housing at scale. But we don't have any here, right? You can't think of a single company. I can't think of a single known kind of owner operator of housing, so of rental housing. So I think that there's an opportunity there, right? And there's a lot of scale economics, whether it be in property management, maintenance, even understanding what unit buyers or renters want to see in their units, and other community-friendly amenities, right? Programs, financial inclusion and education programs, those types of things. They go a long way in engaging your community. So I think that there's a lot of opportunity. We at iJenga are actually pursuing that. So that's how I feel very strongly about it. So that's that's kind of it firsthand. Joseph, I see you've got your camera on. Would love for you to say some comments about this as well, please.
Yes. Perhaps to react to the question from Fred, in respect to especially the members who've just joined the pension fund, who they may not necessarily benefit from the new regulation where they're able to utilize 40% of their benefits for purpose of purchasing homes. But I think there is a window through the TPS arrangement, especially if the pension funds involve themselves in some of these projects, whereby you are able to get hold of this member who really hasn't contributed much, and then you structure a TPS arrangement for that particular member, which means he'll technically be moving into taking possession of the property immediately after construction. And then over a period of time, he'll be basically paying back the pension fund through a structured arrangement. And I think this is a practice where other developed economies have maybe done very well in the way they've structured their pension funds. And allow me, for example, to use a very good example in Singapore. We have a pension fund called Central Provident Fund, and what they've done is they've structured their pension funds in such a way that you have an account for purpose of housing. So as you contribute for your pension contributions on a monthly basis, you also have a separate account to take care of housing. So in this case, the housing does not need to wait until retirement. I mean, Fred, if you look at pension utilization by many of our members when they retire, they use the biggest chunk of that amount, not for purpose of taking care of the retirement, but for purpose of now going to buy a home or build a home from there, which we believe those are decisions which are made very late in life, and it becomes very costly to our members. So if we're able to open that window where our members are able to participate in property ownership while they are still in active employment, then you are sure that by the time these members are retiring, they'll be having their pension benefits specifically designated now for retirement, and they will have sorted out the issue of home ownership. So thank you, Zorava, for that, and Fred.
Thank you very much. So thanks for that great response, and thanks, Fred, for asking that question. I see the time is 11, and you know, that's that was our webinar for today, and I really want to thank the panelists, as Mina, Joseph, Ruth, you know, your comments, your insights, and your participation today. I want to thank all of you for joining the panel today. We hope it's of interest. We hope that we do more of these with KEPFIC as well, and we continue to engage with the pension community. And I'd like to thank KEPFIC for our engagement on today's panel. I want to hand it over to Ngatia for closing remarks. Thank you very much.
Thank you very much, Zorava. I would just to summarize a few interesting things that we have discussed today. First of all, we've learned a lot about how the private sector thinks about the affordable housing or opportunity, thinks about key risks, and the need to manage those risks from the very beginning. We've talked and we've heard from pension schemes and how they think about affordable housing, the role of the fund managers, the education and capacity building required, as well as the opportunities for awareness. We've also looked at the various vehicles that are available for pension schemes and institutional investors to participate in affordable housing, be it direct, be it through tenant purchase schemes or fund route like IHS. And we have also discussed the importance of matchmaking and the role of KEPFIC and KPDA in doing so to ensure that we can bring together the sources of capital and these opportunities. Before I close, I just want to also give my own thanks on behalf of KEPFIC. First, we want to recognize our partners who are on this call. We have the USAID Kenya Investment Mechanism represented on this call. I can see Anne Mwenje is here. We also have MIDA Advisors represented by Dan Bond. I also want to obviously thank the service providers who are on this call, from the administrators like Minette and Zamara, to the fund managers who are on this call as well. We also want to give thanks to our regulators, the RBA, as well as the Capital Market Authority, and of course to our pension fund members and the pension fund community at large. So once again, I will just reiterate that the KEPFIC KPDA partnership is very powerful, and I would say that we'd encourage you all to join both institutions, and we are available to have further discussions on that. Everything we have discussed today, this whole webinar, will be online. We will post it on our YouTube as well as other social media platforms, and we will be sending out the presentation that was made to all the attendees. So with that, I just want to once again thank you so much for making time this morning, and we look forward to seeing you at our next investor education series event. Thank you all.
Wonderful, thank you. Thanks.